So today we are going to look at introduction to financial management. So first of all, we get to know what introduction to financial management is all about. We look at what financial management is, the role, the purpose of financial management. We also identify some core finance decisions. Then we look at how to apply time value of money to simple valuation problems. Use MPV as a primary investment decision rule, right? So we look at what is financial management. So when we talk about financial management, what is it? So financial management is a strategic planning. Is a strategic planning in the sense that you are looking at um, you are estimating how much resources are needed and where these resources will come from. So you are looking at how much resources that you will need to achieve your organizational goal and how these resources are going to come in order to use it to achieve your organizational goal. So in this case, you are looking at planning. Okay, financial management as organizing. In this case, you are looking at your financial resources in a way to achieve your organizational goals and assigning responsibilities. At your capital structure, you look at your equity that you need, you look at your debt and the retained earnings that you have in the business. Okay, so when we talk about directing to financial management as directing, we are looking at how you are putting guidelines or guiding your financial activities like investment, budgeting, and cash flow management in order to achieve your organizational goal. And when we look at controlling as part of financial management, looking at monitoring your performance, comparing actual results against your plans in order to identify variances or deviations and taking in corrective measures to correct these deviations or variances. Okay. Then time management as managing firm resources, managing the firm resources to maximize shareholders' value. Okay, you are managing the firm resources to maximize shareholders' value. So in this case, you are handling everything within the company, which is the resources, which is the people, the money, the technology, the information, which is within the company to with the ultimate goal to make the company worth more, so that shareholders see their investment grow through high share price and dividend payment. Okay, so you are managing the business to ensure that the investment that shareholders have made are yielding returns in terms of higher share price and dividend payment. And when we talk about financial management, we are looking at managing principles to finance with the aim of ensuring from profitability, liquidity, and long-term sustainability. So in this case, um, you are you are employing principles in order to manage your business, in order to ensure that there's enough profit in the business and there's liquidity and long-term sustainability. So when we talk about profitability, we are talking about you earning more and spending less. At the end of the day, you are making profit in the business. Look at liquidity. Liquidity means that you are managing your cash and other easily convertible assets into cash in a way that you can meet your short-term obligations. Okay, when we talk about the long-term sustainability, we are looking at you planning and investing wisely so that the business can survive and grow in the future and not just today. So you are planning, you are putting plans in place, you are investing in a way that the business will survive and grow. It won't collapse, it can survive for many years to come. Okay, so that is what financial management is about. Let's look at the objectives of financial management. So one of the objectives of financial management is to ensure adequate supply of funds for operations. You are ensuring that there's capital available, there's money available for your day-to-day operation of the business. The second objective is that to maximize the shareholder returns while maintaining safety of the investment. You are trying to ensure that the investment that shareholders have made, at the end of the day, it is going to yield a return, which in a form of higher capital gain or um, higher capital gain, which is the higher share in price and the dividend payment. Okay, so and ensuring that this investment that they've done, they are not going to lose that investment. It is in safe hands. And then the next objective is that you are optimizing optimal utilization of fund at the lowest possible cost. So the fund that has been given to you, you are putting it in a way that you are maximizing it. You are using it to yield the maximum profit that they want, the maximum return that shareholders want, at a cost which is low for the running of the business. And the next one is you are maintaining a sound capital structure. In this case, you are ensuring a right balance between debt and equity. You don't want in a situation that you are employing too much debt and you are employing too much or you are employing too much equity. You want to ensure the right balance, the right mixture between debt and equity. And one of the objectives of financial management, which when you understand financial management, it helps you to maintain a sound capital structure in running your business. Look at some functions of financial management. One is estimating capital requirement based on your future plans. So based on your future plans that you have as a business, you estimate the capital requirement, the money, the resources that you may need to achieve this future plan. So financial management helps you to estimate this capital requirement in achieving this future plan. The next one is determine capital composition. So in this case, through financial management, you're able to determine the right measure or the right mixture between equity and debt in running your business. You don't want to employ too much debt, you don't want to employ too much equity, but you want to ensure the right balance between these two in order to achieve your objective. And the next one is you are managing your cash flow to ensure liquidity. So in this case, you are managing your resources to ensure that you meet short-term obligations. And the next one is financial reporting and compliance with regulation. That is another function of financial management. So when you understand financial management, you are able to um, prepare and present your financial statement in an accurate manner. And with compliance with regulations, you prepare your report that meets legal, professional, and regulatory standards like IFRS, GAAP, ICAG guidelines, tax laws, and other regulations which are necessary within the industry. The next one is risk management to safeguard against uncertainty. So you are managing the risk. So through financial management, you are able to manage the risks. And in managing the risk, you are identifying, assessing, and minimizing the impact of uncertainty that could harm the business. So through risk management, you are able to identify, assess, and minimize the impact that may affect the business in the future. The uncertainty that may occur is market fluctuation, credit credit defaults, regulatory changes, and many others. Okay, so that is all about functions of financial management. There may be more, but this let's limit ourselves to this five. Let's look at some core financial decisions. Okay, some decisions under financial management. So one is investment decision, which is your capital budgeting. In this case, you are looking at the allocation of funds to long-term assets. You are making an investment and you are looking at how to allocate funds to this investment. And in doing that, um, you have to analyze this investment to know that at the end of the period you are making the right investment decision or not. And in doing that, there are some techniques that you may employ or some method that you may employ in evaluating your investment decisions. One is the MPV. MPV is net present value. So here you are looking at the difference between present value of cash inflow and the present value of cash outflow. Okay, you are looking at the difference between present value of cash inflow and the present value of cash outflow. So MPV is your present value of cash inflow minus present value of cash outflow. And in using this method, you accept the project if your MPV is greater than 0. Let's look at the internal rate of return, which is this. For the internal rate of return, which is the IRR, you are looking at the discount rate at which your MPV is 0. MPV is equal to 0. The discount rate at which your MPV is equal to 0. So in this case, um, in terms of making your decisions, your investment decisions using the internal rate of return, you accept the project or the investment if your IRR, which is your internal rate of return, is greater than the cost of capital. So IRR is greater than cost of capital. So we look at the payback period. Under the payback period, we are looking at the time it takes for cumulative cash inflow to recover the initial investment. Okay, and under this method, we have the discounted payback period and we have the undiscounted payback period. Discounted one, you have to discount all the cash flows, then use that one to determine the payback period. Then undiscounted one, you use the raw cash without discounting it to determine your payback period. And making decisions, you pick the investment or the project period with a shorter payback period. You look at the PI, which is a profitability index. So the profitability index is the ratio of your present value of cash inflow to the present value of cash outflow. So you are looking at present value of cash inflow divided by the present value of your cash outflow should give you a profitability index. And using this technique as a method to make your investment decision, you always accept project one when your profitability index you is greater than 1. So let's look at the financing decisions. The financing decision, that's your capital structure. Trying to look at the right balance between your debt and equity in running your business. So in this case, you want in a situation that you are not employing too much equity, you are not employing too much debt. Because in employing too much equity, you are going to face high financial risks, which is you paying your interest and repayment of obligations, which is the principal. And also, when you look at you employing too much equity, you are looking at dilution of ownership of the business or and high cost of capital, right? So high cost of capital. When we talk about cost of capital, we are looking at the average rate a company must pay to finance its asset or business. The weighted average capital combines the equity and the debt. So in this case, it combines the cost of debt and cost of equity weighted by their proportion in the capital structure. The formula for the weighted average capital is your portion of your equity. Okay, the portion of the equity over the total capital structure times the cost of equity plus the debt portion of the capital structure over the total capital structure times the cost of debt into bracket 1 minus T, which represent the tax shield. Leverage analysis, we are examining how it affects profitability and risk. We are looking at a way that when we employ debt into the business as our capital financing, what will be the effect on our profitability and the risk associated with we employing this debt as our financing options. For the dividend decision, we are looking at how profits are distributed between dividends and retained earnings. So at the end of the day, the profit that you get from the business, you have to know the portion which is going to shareholders and the portion which is being maintained in the business as your retained earnings. And in doing this, you have to look at some of the models or some of the theories that support this kind of decision. We have the Walters model. The Walters model argues dividend policy is relevant to the firm's value. Paying dividend to shareholders is very important. It is irrelevant. And it continues to say that, okay, if your firm's return on investment is greater than cost of capital, then you have to retain your profit as your retained earnings. Now, if your return on investment is greater than your cost of capital, then it's better to reinvest your profit as your retained earnings instead of paying dividend. The situation that your return on investment is less than cost of capital, then you don't reinvest that. You just have to pay the profit as dividend to shareholders because shareholders could get better options somewhere. Then you look at Gordon's model, which is the dividend growth model. So the dividend growth model, which is a Gordon's model, argues that dividend is also relevant in the business. Okay, and it says that shareholders prefer dividends as of today over uncertain future capital gains. Okay, they'll prefer to get the dividends now rather than waiting for any capital gains in the future. So here is saying that your value of shares is equal to the present value of expected dividends. We look at MM hypothesis, M&M, which is Modigliani and Muller model. So the Modigliani and Muller models state that dividend policy is irrelevant. So this model is saying that dividend policy is irrelevant because they are arguing that in a perfect market where there are no taxes, where there are no transaction costs, and there are rational investors, then there's no need to pay dividends. Okay, in this case, dividend is irrelevant. It is unnecessary. It is not important in this type of market. So they are arguing that a firm value depends only on investment decisions, not on how profits are split between dividend and retained earnings. Let's look at working capital management. So for the working capital management, you are managing your current asset and current liability to ensure liquidity, right? As I said earlier, liquidity is like making sure that you manage your resources in a way that to meet your short-term obligations. Current ratio, which is your current asset over current liability. Quick ratio, which is your current asset less inventory over current liability. Cash conversion cycle measures how long it takes for company to convert its investment in inventory and other resources into cash from sales. But looking at the time it takes to convert your inventory, receivables, and payables into cash, right? So we look at a formula like CC is equal to DIO plus DSO minus DPO. So the day inventory outstanding is the average time it takes to sell your inventory, and the day sales outstanding is the average time it takes to collect your receivables, and the days payable outstanding, the average time it takes for you to pay your suppliers. EOP is the economic order quantity. So for the economic order quantity, we are looking at the optimized order size that maximizes total inventory cost. Okay, you are looking at the ordering and your holding cost. The formula for this is your EOQ is equal to square root of 2DCO over what? HC, where your D is annual demand, which is in units, then your CO is the ordering cost, and your HC is the holding cost. So the rule under this is that order at EOP level, because at this level you minimize your total cost of inventory management. There are some guiding principles of financial management. So the guiding principles of financial management, we look at the time value of money, which there's a popular saying that money today is worth more than money tomorrow. We look at the risk and return trade-off, which is the higher the risk, the higher the return. We look at the cash flow drive value. We only use cash flow for your valuations and not accounting profit. A market price reflects information, which is the same as the efficient market concept. So, under the efficient market concept, efficient market hypothesis states that market prices fully reflect all available information. In other words, it's trying to say that stock prices adjust quickly to new information so that no investor can constantly incur or earn excess return using publicly available information. So, under this market or under this concept, you're trying to see that in the market, the prices adjust to new information in the market, and no investor, based on the publicly available information that they have, they can make any excess return on their investment without cheating or having any insider information. When we look at the future value and the present value, so here we are looking at when you have money today and you invest that money in the future, how much you are going to get. So the formula is present value, which is the money today, bracket times bracket to be 1 plus r to the power n. So r here is our interest, and the n is the number of years or period that you are going to do the investment. And the present value is you are having the money in the future and you want to bring it to. So in doing that, it will be your future value over 1 plus r, your future value over 1 plus r to the power n, right? Then we have annuity. So for the annuity, we have the ordinary annuity and the annuity due. So annuity means that there's a regular payment, and the payment can be done at the beginning of the year, which is annuity due, or at the end of the period, which is ordinary annuity. For ordinary annuity, we have the present value and the future value. So in calculating the present value, you are looking at your periodic payment bracket to pin 1 minus 1 plus r to the power minus n over r. Then if you are looking at the future value of your periodic payment, which is the ordinary annuity, you look at the periodic payment bracket to be 1 plus r to the power n minus 1 all over r, right? For the annuity, because the payments are done at the beginning of the year, we look at the present. So looking at the present value, you are saying present value is equal to the periodic payment bracket to be 1 plus a 1 minus 1 plus r to the power minus n over r bracket close times 1 plus r. Because this one is done at the beginning of the year, there will still be 1 plus r. So we'll add 1 plus r to the end of the formula. Then for the future value, it is your periodic payment bracket open 1 bracket open 1 plus r bracket close to the power n minus 1 all over r times 1 plus r at the end. Periodic payment for perpetuity, it will be your PMT over r. So that will give you your perpetuity. So let's look at this example. So they are saying that find a present value of a future amount of 1,000 in 3 years at a rate of 10%. So here, your present value is equal to 1,000 divided by 1 plus 10% to the power n, right? To the power n, which is 3 to the power 3. So what you do is you should get um, your figure, right? Then we look at the valuation basis. So we look at the discounted cash flow, then bonds, look at stocks, look at the decisions of using the NPV to accept or reject a project. Then you look at capital budgeting method, the NPV, look at the IRR, look at the payback period, then profitability index, we also looked at it. Then the cost of capital, we also talked about cost of debt. Then cost of equity, look at it. We looked at the weighted average cost of capital. Working capital management, you look at cash, look at inventory, look at receivable, and also look at payables, right? Look at the balance between liquidity, you be able to meet your short-term obligation and your profitability, right? And you also look at your budgeting, look at your inventory turnover, look at the credit policy management, able to manage your credit policy. Then look at corporate governance. Under the corporate governance, we are looking at agency problem, where managers may act in their own interest instead of the shareholders' interest. Okay, in this case, to solve problem like this, you have to use performance-based compensation. So you compensate managers based on their performance, and there should be a board oversight on managers on how to go up and on their day-to-day activity. Yeah, system should be put in place to ensure transparency. So this is one example that you have to look at it. So they are saying that evaluate um, 500,000 projects with cash flow of a cash flow 1 year, 150,000, 2 year, 200,000, 3 year, 220,000 at a discount rate of 12%. So evaluate 500,000, which is your um, initial investment. This is your cash flow for year one, cash flow for year two, and cash flow for year three. So this is uneven cash flow. So what you do is that you discount these uneven cash flows to their present value, then you less your initial investment, which will be the 500,000. So the difference that you get will be your MPV.